Let's bring in Jim Bianco, joining me here from Bianco Research. Jim, good to have you on the show here for a big day for market. It seems like Powell surprised folks with the dot plot that we saw, but I'm looking at equities unchanged since he came out with the report. I'm seeing bonds like to the moon. I'm seeing gold with a little bit of a bid as well. So tell me what's going on here. Let's try and parse this out. Firstly, what does it mean for the economy from these words?
That low rates are going to be here to stay, that we don't expect the Fed to raise rates this year, next year, or even in 2022. So we've got 2 years of negative interest rates. I thought the most telling thing he said, as you teased going into the break, was the last question about whether or not the stock market was overvalued. He was asked that question twice, and he kind of avoided answering it 2 times as well, too. And I think the reason he avoided answering it is Fed's not going to do anything about it. They have an easy policy to try and help the economy. If that has been a catalyst for speculative fever, especially on the low end among small retail, which is what everybody's been talking about, then so be it. That's kind of where I think the Fed is with it right now. They're not going to pull back because the market seems to be getting a little bit frothy. That's probably the biggest takeaway from it. So for investors, there was nothing negative there. No rate hike, and don't worry about froth. We're not going to back off if we see any signs of it. In fact, we're not even looking for it right now.
So here's the question. I mean, should we ignore the intraday activity here, Jim? Or because when I look at a stock market unchanged, if the logic that you're laying out is that markets are basically only up because of the Fed, I mean, I would think stocks would be going wild right now. How come we're not up?
I think that was largely expected. What the Fed said, there was no real surprises other than that they underscored it. The dot plot that they're not going to raise rates for 3 years, that was not a big surprise either. So there was nothing in that data that suggested anything that we didn't already know. So I think the stock market's been somewhat muted by it because it wasn't a great shock. It was just interesting to see him do it because he hadn't been asked that question in several months.
Jim, as far as the economy goes, I know the market, we can debate for a while how much is speculative froth, how much is about a real turnaround in the economy. But from what we're seeing over the last couple months, you and I have been having an almost monthly conversation here. I know about a month ago, you were getting ready and looking for weakness to come back into risk assets because of the virus, because of the weakness in the economy. Is that still there, or we still should be preparing for an economic, hit?
Yeah, that's a good question. You're right. I had gotten that wrong by thinking that we were going to see some kind of a sign that we were going to get more weakness, maybe an uptick in the virus as well, too. And to some extent, we've gotten at least the latter part of that. We've gotten an uptick in the virus in places away from the big urban areas. Yeah, but that doesn't seem to be at play in this market. I don't even think a vaccine is in play in this market as well either, because some of the biotech stocks are no longer really moving on any of that news as well. The economy is recovering. This week is better than last week. Next week will be better than this week, and it will continue to recover. My concern, as I was expressing a month ago, was we got to get back to 96% of where we were just to basically rerun the 2008 depression or recession, Great Recession. If we go back to 80 or 85% of where we were, that would be more aligned with a depression. And as of right now, the economy is recovering, but it's still probably in that 85 or 90% range, which is where I would pretty much say it was a depression as far as where it is. We need to get almost all the way back. I'm still skeptical we're going to go all the way back. And I think once people realize we're not going to make it all the way back, that's going to be problematic for the economy. I think that's what the Fed is most worried about, which is why they basically said no rate hikes for 2 years as well, too. But the market's not looking at it that way. It's looking at it in a completely different way. It's looking at reopening. There's speculative froth, I believe, coming in at the low-priced areas and in some of the beaten down areas as well, too. and that's going to continue to drive the trade right now. So it looks like the market's going to just continue to grind higher until something dramatically changes. And coming up short of goals isn't going to be it. At least it hasn't been so far.
Jim, I think this is a pretty interesting way to think about it in that percentage term. I actually really like that because this is, I think, the only really way to consider it is a percent of where we were before. NASDAQ says we're going somewhere for those companies that's beyond where we were. The S&P right now is about 5% below where we were. So if the stock market's a forward look at the economy, they're saying that, okay, as of now, we could get back to 95%. But if that is not where we are, then it means the stock market's ahead of the reality. So I follow that, and I like the way we think about that, because then it brings up the question, okay, well, what could make that apparent to investors? Is it going to be a fumble by fiscal policymakers, where we go, wait a minute, hang on, 95%, we're not there yet, so the stock market gets in line with the 80 to 85 you're describing? Is that the obvious one? Is it if Texas says, look, guys, we got to shut down again? I mean, what's the clear roadblock that could happen?
It could be either one of those. You know, fiscal policymakers could come in and say, hey, look, everything's going good. The Republicans could really push back in the Senate and say, no more extensions on unemployment or any more stimulus. We have to back off, start worrying about the deficit. That could be one. It could be another one. Texas is going to be an interesting one to watch. I'll just point out that if you look at the data, the case counts are really spiking in Mexico right now. And it's just over the Rio Grande. And that might be bleeding into Texas as well, too, because the migration tends to go from south to north down there. But as far as the 95% goes, you're right. The big FANG stocks and Microsoft, which will lump in with the rest of the stay-at-home stocks, they have been doing very well. They're more than 100% of the way back. I understand why they should be. This type of environment is very good for them. Take them out of the S&P, and that 5% off the top is more like 10%. So the non-FANG S&P stocks are still more like around 10% from their old high. Mm-hmm. That's more consistent with a 90% recovery right now. So we'll have to see whether or not that is where people play this out right now. But like I said, for now, it seems like everybody's just looking at the numbers absolutely. This week was better than last week. Next week will be better than this week. And that seems to be, as far as we want to take it, it's all okay. We're getting better every week. And that is spinning a bullish story for right now.
Jim, I want to make sure we get to bonds because when we've been talking about yields and the low for yields, when we discussed this right after the Fed unloaded the bazooka, your point was that very well may have been the bottom for yields. Then we followed up a month later. It looks like that was it. Does today change any of that? Because it looks like we were heading for that to be the right view, that we got the bottom back in March for the 10-year yield. But does this change that, or is this just a short-term rally in bonds that will continue to fade once investors realize there's negative rates that are not a reality and that we can continue to try and improve the economy?
No, I don't think that's going to change it. I mean, if there was one slight surprise in what Powell said, is he said that the bond buying that the Fed is doing right now is pretty much at the floor of what they're going to do.
I agree.
That's $120 billion a month. That's $80 billion of treasuries, $40 billion of mortgages, and that will continue month after month after month after month. The balance sheet's going to get a lot larger, is what he basically told us. And that will be somewhat supportive of bonds. Bond market, I do believe the 39-year bull market in bonds ended in March at 33 basis points. They have been drifting higher. They've come down a little bit more to the top of their range right now. But the bottom line is, I think the fundamentals are pulling bonds higher, big supplies coming. I still believe the market's worried, as I am, that in 21, 22, you might see an uptick of inflation as well, too. That's the story for pulling higher. The story for holding them down, $120 billion a month for 2 years from the Federal Reserve. That's a lot of bond buying that can help hold them down. You kind of meet in the middle, and that's why we're trading, towards the top end of this range, around 80-ish basis points or so. And I think that that's where we're going to stay, at least for now, with the risk being rates go up rather than rates go down.
Jim, I got last one, just real quickly, yield curve control. Thoughts on whether or not, if they announce some kind of measure that controls the front end of the curve, is that bullish or bearish for the 10-year? What does that mean for the 10-year?
I think that they will announce it later this year if necessary. I think it's neither. I think it's neutral, because the whole point of yield curve control is price fixing. It's you fix the price so it doesn't move. They would announce it on the short end, 2-year, 3-year, maybe out the 5-year. Here it is. These are the prices. Those instruments are done. They don't move anymore because the Fed sets those prices. That has a powerful impact on the back end of the curve to wring out volatility. I think the biggest thing most of your investors need to understand about yield curve control, it divorces the bond market from the underlying fundamentals by design. The Fed is doing that on purpose so that when you look at interest rates, they tell you less about inflation and economic growth than they normally do when they're freely traded. And that's going to be something that we're going to have to grit our arms around if they indeed pull it off later this year.
Okay, Jim Bianco, great to catch up. Really good conversation, per usual. Jim joining us from Bianco Research and the closing bell.